Why was it important to have a secondary listing in Hong Kong?
Yes, since 2016, we went listed in New York Stock Exchange. We've been receiving support, understanding, and recognition by the investment community within North America and also globally. But I think with us listing in Hong Kong, Hong Kong being the largest global IPO venue since the past 10 years, right? 6 years out of the 10 years, it's been the leading platform for raising IPO dollars. In fact, since 1993, it has raised 6 trillion Hong Kong dollars of offshore. It's a platform for mainland Chinese companies to receive great support and recognition. So I think with the US and Hong Kong listing, ZTO's story would be better understood, and also our value could be recognized on a much more global basis because it provides flexibility, greater access to a much greater investor base for ZTO.
You've raised about $1.3 billion in this secondary listing. How do you plan to use the proceeds? You mentioned about infrastructure and capacity development. Can you give us a little bit more color on what that entails?
Yes, I think since 2016, we've started to recognize ZTO's advantage in consolidating and access to the resources that we could integrate, so that looking at the greater opportunity within China, not just in the express delivery industry, but in a greater span of logistics subsegments, including less than truckload, cold chain, in-warehouse processing, plus the shipping, as well as many other adjacencies, we believe we are better positioned to get into a greater eco-sphere. And that's why we started to design and plan for investment for multifunctional logistic capabilities, so that to maximize our resource and also the advantage that we already established in terms of infrastructure. So infrastructure is going to be the main use of our proceeds. And at the same time, we still believe the entire network stability is important. And of that, our network partners will remain confident and remain loyal to the brand. So they start to invest. Some of the larger ones reach certain level. They need to expand their facility. They need to expand their capability of serving total, what we have, 50 million going towards 100 million volume each day. So the whole network needs to come together. What we do is leveraging our understanding of the nature of the business and also the substance of business, and providing financing for our network partners to continue to support them. And then, of course, building our entire ecosystem, building its dovetailed whole framework, we do intend to use the proceeds for that.
But Huiping, this is a highly competitive space, not just from domestic players, but international players as well. I mean, when you talk about your competitive advantage, what exactly is that?
Yes, in the past 18 years since the founding of ZTO, we've been building our scale capability, operational efficiency capabilities. Yes, the model, I think, is very different from what the Western familiar model of vertically operated and owned model, because it is a network partner model. Yet because of the economic background, e-commerce growth, it requires rapid expansion. The network partner model afforded great flexibility and speed in reaching wider and deeper penetration and wider coverage. So in that sense, we were able to grow in a rather rapid way. Now, for us to continue to expand and continue to grow, the industry, while it's still consolidating, the leadership in this space, from our culture, which is the shared success, so the whole network is balanced. From our infrastructure, we have the largest self-owned facility space. We have the largest fleet with over 9,000 high capacity trucks included. So these capacities are not built overnight. And with those, we have the cost advantage, we have the scale advantage and leverage going into the future as market continue to expand, continue to grow. The opportunity is there for us to leverage our existing capability with people, with financial resources, with hard assets, right? It is not a light asset model. We are able to build upon the know-how, the focus on our strategy to continue to grow scale, market share, quality of services, and maintaining a healthy level of profitability. Competition is strong, but we think that long-term speaking, competition strength comes from the scale, comes from the quality of services and operational efficiency. And that's what we've been focusing on and intend to continue to focus on. While in the future, by year 2022, we hope to reach at least 25% of the market. And with that, we will further expand our leadership compared to our peers and also some of our model companies that we are looking to pull and fill the gap. For example, our brand recognition, our time-definite products, right? The cold chain operation together with our existing business should help us in further leverage our advantage.
Huiping, we also know that ZTO is among, a dozen delivery companies working very closely with Alibaba. Have you received any guidance from Alibaba?
Alibaba is a great partner in terms of supporting the entire logistic business in improving standard of services, improving efficiency. Alibaba's logistic arm, Cainiao, has taken on the mission to use its data and technology platform to support, to empower the logistic players so that it could elevate the entire Chinese logistic market capability as well as efficiency. And since the investment, or even prior to the investment by Alibaba-led syndicate in 2018, we've been working closely with Alibaba, for example, in the way we develop the automation recognition, because the e-way bill, right? This is something that Alibaba Cainiao provided and initiated for the entire express delivery industry. The last mile post operation, which is where all these are specific, including time-definite products. Those are a collaboration, a successful collaboration with Alibaba.
Huiping, we mentioned a little bit about the price competition among some of these delivery firms in China. That certainly has been a big key concern among investors. How is this weighing on your margins? How long do you expect this price war to last? And can you actually continue to gain market share without lowering prices?
Yes, I think the answer to your last part of the question is definitely. We believe when you have capacity, when you have strong operational efficiency, volume will gravitate towards you as opposed to price. And that is why we have accelerated and dialed up our intensity in growing our market share, expanding our leadership gap so that we are becoming the true leader and absolute leader in terms of the whole competition. Pricing is not long-term. Yes, indeed, of recent, the margin for the entire logistics, specifically for express delivery industry, has declined. But we think this is most likely the darkness before the dawn, because we continue to focus on building capacity. Ward off, the way of warding off competition is indeed your capacity, your capability of taking in as much as volume possible without giving up quality of services. So we think looking forward towards the end of next year, perhaps the price will start to stabilize and resume. If you consider the low, very low price already in the express delivery industry, with volume, with the growth prospect intact, the future profitability will arrive, and will arrive sooner than you think.
Okay, margin boost is perhaps, or stabilization is one thing. What about when it comes to costs? What are you trying to do on the cost side to try to mitigate some of these price pressures that you're dealing with?
Yes, the cost productivity in the past has been consistently achieved by ZTO. We have a philosophy of investing the right amount of money at the right time, doing the right thing. So we've been systematically matching our investment with the incoming volume. So as we continue to expand, the labor dependency will continue to decline. We have automation, we have greater technology implementation, so that it's more accurate and more efficient. Our fleet, because of our self-owned facility, could be better integrated and matched up with the capacity of our network transit capability. And as volume increase, the network itself will continue to evolve to reach to maximize the productivity efficiency. So we have roughly estimated in the next 3 to 5 years, with the already low cost per kilo at around 50 cents, we will look towards another 25 or maybe even 30% of decline in the per unit cost. If I just give you one set of data, in 2010, our cost is 2 RMB per kilo. In 2016 is 1.08 RMB per kilo. And in the past quarter, we have achieved 50 cents. So with volume continue to expand, our capability and our service, the definitive products, so on and so forth, would help us even improve our per unit cost efficiency.